is my article in a series of articles that I've written. This is the third and final one, and I called it Annus Mirabilis. The markets will be more Darwinian. The recent series of articles was headlined Annus Horribilis, which is a Latin phrase, meaning complementary to Annus Mirabilis, which means wonderful year, and therefore in the spirit of Tennyson's The Death of the Old Year, which concludes, "His face is growing sharp and thin, alack, our friend is gone. Close up his eyes, tie up his chin, step from the corpse and let him in. That standeth there alone, and waiteth at the door. There's a new foot on the floor, my friend, and a new face at the door, my friend, a new face at the door." We should pronounce 2018 and its Annus Horribilis dead, and let's embrace 2019 and Annus Mirabilis. In my preceding articles, I looked at geopolitical risk, the Trump impeachment spike to 50%, the tariff war, which I think will bite hard in 2019, the China slow down, it's slowing down sharply, the dollar, about which I'm significantly more bullish than consensus, the nosedive in the crude oil price coincident with the Khashoggi incident. I touched on Europe being off balance and the fact that the streets of Paris, the beating heart of Europe, was a Virilian metaphor. Paul Virilio, in his book Speed and Politics, says, "The revolutionary contingent attains its ideal form not in the place of production, but in the street, where for a moment it stops being a cog in the technical machine and itself becomes a motor, a machine of attack. In other words, a producer of speed." Let's cast our gaze further. Emerging markets were a train smash in 2018 and are tentatively picking themselves up from the floor after a rout that's wiped about $5 trillion off the value of stocks since the high in January 2018, Bloomberg Economics. The theory is dead simple. Emerging market assets have already bombed, so the downside, if things get worse, is much lower. And if things recover, they have greater potential to perform, said Anthony Peters, an independent analyst. However, they have the potential to go much lower for much longer than anybody had ever thought possible. I conclude there by saying, take your pick. I recall being at a presentation last year given by Standard Chartered's chief economist, Razia Khan, and every single African sovereign bond issuer was clustered within 50 basis points of each other, 10-year maturity. For some reason, the phrase, "it makes no sense, it must be nonsense," kept popping into my head. The point is this. Since 2008, the markets have been fire-hosed in a tidal wave of liquidity. The chart that Razia showed that day was the most extreme example of the consequences of that liquidity fire hose, from the Dow Jones to the German DAX to EM and sub-Saharan African sovereign spreads. We're in the midst of the great unwind from a decade-long liquidity fire hose. Of course, I'm not suggesting we're headed into Mellon doctrine territory. Mellon believed that economic recessions such as those that had occurred in 1873 and 1907 were a necessary part of the business cycle because they purged the economy. In his memoirs, Hoover wrote that Mellon advised him to liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, purge the rottenness out of the system. High costs of living and high living will come down. Enterprising people will pick up the wrecks from less competent people. Now, the lesson I'm drawing is this: the markets will be more Darwinian. It will reward winners and punish the losers. Therefore, we too will have to differentiate. In the case of the BRICS, Brazil was a big outperformer last year. China has rerouted a lot of its agri-demand in their direction as well. They have been a winner so far in the tariff war. However, we've all noted how a bump can morph into a slump real quick. Just look at Mr. Trump. Russia under Mr. Putin, whilst projecting outsized geopolitical power on an Italian GDP level economy, has proven resilient, but another swoon lower in oil will surely test its mettle. India has an election and Prime Minister Modi, while surrounded by Z on all sides, seems to be losing his shine, which always risks him going full-on Hindutva. China's Shanghai Index was the worst performing index in the world in 2018. These are indeed choppy waters for the BRICS at the macro level. We will have to dig deeper to earn our returns. There is a lot of growth in these economies. You just have to position yourself in the right place. Africa had a tough time in 2018. Borrowing costs spiked higher, currencies lost ground against the dollar, and stock markets retreated. South Africa and Nigeria, 50% of sub-Saharan African GDP, go to the polls in 2019. Both economies have been in the slow lane and need a positive catalyst. Whilst on the continuum of political impact and change, Prime Minister Abiy ranks first. President Ramaphosa has made steady progress in rolling back the Zupta state and trying to put the Rainbow Nation on an even keel. Nigeria is at risk of being walloped by a lower oil price. Ivory Coast and Ghana, underpinned by firming cocoa prices through 2018, coupled with sensible macroeconomic policy making, have been a bright spot. Here in East Africa, Abiy's Ethiopia continues to lead the GDP charge and will be the fastest growing economy in the world in 2019. Investors are looking for the rand. That is dependent on the speed and execution of the administration. Here in Kenya, we popped towards 6% GDP on good rains. The shilling performed better than the yen, but the stock market retreated around 24%. In Tanzania, investors are having to price in a Magufuli haircut. Many are electing not to price at all. Last year, the best trades to have done in the markets was to have bought 1-year government of Egypt or government of Kenya treasury bills and run the currency risk. Both trades achieved double-digit dollarized returns in an environment where 93% of all investments worldwide last year were underwater. Deutsche Bank. So I think wherever you are, you need to get a lot closer to the ground. In the case of the continent, if you're not on the continent, then I'm afraid you know nothing. The preceding article was written on the 31st of December, Annus Mirabilis, Cash is King, Part 2. The link is on Rich Wrap-Ups. Global stock market pin hopes on Sino US talk as year-end deep in red. Asia, Europe, almost all Asian indices in the red in 2018. To the point about the markets. I wrote that the US market swooned and served up the worst Christmas since 1931. I think I said. Now seems to be the case. Holger tweeted, US stocks, which seemed invincible until mid-year, have posted the worst December performance since the Great Depression. And then the original article was from the 24th of December, Annus Mirabilis. Markets are now pricing in an 89% probability that the Fed will not hike rate this year. I don't think that's likely. I think they will.